Hi, I'm James Robinson, and this is a Robinson Stocks stock pick. This is the fifth and final video on the company Maine Foods, symbol CALM. Today we're going to talk about the company's wealth creation, and I define wealth creation as the propensity of the management to create wealth for the shareholders over the long term. The first thing that I look at when looking at a company and trying to determine wealth creation is what's happening with the share count. Generally speaking, good companies are able to reduce the share count over time. Less good companies, poor companies, oftentimes will have the share count increase over time. The problem with the share count increasing is that it is diluting the shareholders. The shareholders will own a smaller amount of the company over time than they did when they first bought their stock. Whereas if they're buying back shares, then you own an ever larger percentage of the company. So when you look at this company, you'll see that this chart, it looks like it goes up pretty dramatically up and to the right, which is not what I like to see. But if you look more closely at it and you look at it in context, which we'll do in the next slide, you'll see that in 25 years, the stock went from about 47 million shares outstanding to about 49 million shares outstanding. So they sold about 2 million shares over a 20-year period. Again, I don't ever like to see shares being sold, but in this case, what's happening is the company's not really selling the shares. What they're doing is they are distributing shares to executives and to stock options. And while I don't love it, and I would like to see the company buying back those shares instead, it's a small enough amount over a long enough period of time that I'm not going to give the company a black eye for it. One of the things that happens when you look at these stocks with a company is you can't have any hard and fast rules. You can't simply say, hey, if this happens, I'm not going to buy that company. Oftentimes there are mitigating circumstances that explain why the company is doing what it's doing. For example, this company for a very long period of time was controlled and owned by one family. And that family was giving shares to executives as an effort to retain them. And because they controlled the company and it was a small enough amount, they weren't really worried about the optics. At least that's my take on it. So I'll talk about in the next slide why this isn't important. But for now, if you look at these numbers, I think you look at this slide, this video in its totality, I think you'll agree this isn't a big enough reason to rule out this company. So hopefully this slide will put the issue of the shares outstanding into context. If you own 10% of Calm stock, Calm is the symbol for Maine stock at the end of 2014, you would have owned about 4.8 million shares. Today, as a result of stock sales or stock options given to employees, your 4.8 million shares would have decreased your ownership in the company from about 10% to about 9.8%. So just under a 2% increase, just under a 2% decrease in terms of the number of your percentage ownership of the company. But your share in the company's earnings would have gone from 109 million to 628 million over the last 10 years. So even though you own a little less percentage of the company's earnings have grown so dramatically that I don't think anyone's losing any sleep over it. Looked at another way, your earnings per share would have gone from $2.26 per share to $12.27 per share. That's based on the last 12 months. So you can see here that, yeah, we own a little less percentage of the company, but the company has grown so dramatically that we didn't really get hurt through that process. Another thing that we look at when we're thinking at the management's ability to make the shareholders wealthier is to look at shareholders' equity. Shareholder equity is just the total assets of the company minus the company's total debts. And you can see that 20 years ago, this company had a equity of about, let's call it $100 million. Today, it's about 1.75 billion. And that number's grown pretty much every year. So this management and ownership has increased the assets, and the deficit, the liabilities and debts haven't kept pace. And so this company's become more and more valuable on a book basis, basically every year for the last 20 years, which is really a really good sign in terms of the job the management's doing. I'm looking at this slide, which is shareholders' equity per share. It's gone up basically the exact same rate, minus 2%. But again, the amount of equity backing up our shares is excellent and continues to grow and bodes well for the future. There's an old saying that it takes money to make money, and that's true. The real question is, how much money does it take to make money? And the way we measure that is return on assets. So this is the amount of money that's coming into the company based on the total amount of assets the company employs to utilize to perform its job. The red line in this chart, which is about 11%, is a return on assets that would put you in the top 10% of all the companies I've looked at. This company is solidly above that. One thing to keep in mind is that this company is is a cyclical business. And in the peaks, it does very, very well. In the valleys, it does less well. But because eggs are such a staple, I recognize there's going to be some downtimes. And with the exception of 2016, the downtimes are still not horrible. And the good times are so spectacular that that's why we've seen the equity of this company increase as we've seen earnings and the other factors we're going to talk about. The return on equity for this company, this slide looks at return on shareholders' equity. Return on shareholders' equity is calculated by looking at the total assets and you subtract the debts. The problem that this company has with this chart, with competing with so many companies, is that it has no debt. When a company has debt, then it has less equity. And when it has less equity, then it gets a higher return on equity, right? That's simple math. When you have no debt, your equity is higher, and so the same amount of returns generate a lower return on equity. And that's kind of a lot of gobbledygook, but trust me, that makes sense. So what I'm saying is it's hard for companies with no debt to compete on shareholders' equity with companies that have tons of debt. The offset of that is obviously you're in way better shape in the bad times, but in the good times, you look like you're not competing as well. I'm more than happy to live with that. And while this company is, kind of averaging right around the green line, which puts it in the top 25% of companies, that's considering that it's competing with all these companies that have virtually no equity and thus are able to really leverage their returns. Retained earnings looks at, there are 5 things that a company can do when it makes profits, right? It can pay down debt, it can hoard cash, it can pay dividends, it can buy back stock, or it can retain earnings and invest them back in the business. Generally speaking, I like to see if a company's going to be retaining earnings, they need to demonstrate to me they can effectively and intelligently use those retained earnings to create additional income. But in general, I like to see companies that don't retain a lot of earnings. And you can see here that through most of their history, the retained earnings for this company have been very, very small. In the last 2 years, there's been a significant increase in the retained earnings. There's a really good reason for that. One of the largest buyers of eggs in America is McDonald's. McDonald's has made an edict that it will not buy eggs from producers who do not use cage-free chickens. And as a result of that, this company's had to invest several $100 million in the last couple of years to convert their facilities such that they meet the requirements of McDonald's for cage-free chickens. The result of that conversion is that the company's had to retain a bunch of earnings and make that conversion. It's a profitable conversion. It's something they had to do, and I don't think it's something that will continue in the long run. And so I would expect that the retained earnings for this company will level out at a lower level than they are right now. That's one of the things that, and this issue, by the way, is one of the things that can be gleaned from doing the extra research in a company that a guy like me has time to do, to read the annual reports and to really try and understand what's going on in the company and dig in. And I'm not sure a lot of investors have the time, energy, inclination, or interest to do that, but it does create value if you do that homework. So this is my short way of saying, if you're going to be buying stocks, you should take some time to read the annual reports of the companies you're looking at. So this is a chart which is very telling. This is the return on retained earnings. So what I've done with this chart is I've said how much earnings did the company retain over a 10-year period of time, and then how much did the earnings increase over that period of time, and I compare them to each other. And the result is that this company has retained very, very little earnings, but those earnings that they did retain, they didn't create much value from. Which wasn't a problem because they retained so little, it wasn't a significant issue. In the last few years, they retained quite a bit of earnings, and they were able to, as demonstrated here, generate significant returns on those earnings. And that tells me management's doing a good job. One of the things you have to understand is that when you're looking at manufacturing companies, and in one real sense, a livestock or agriculture business is just a manufacturing business, you have a lot of plants and physical equipment that you have to maintain. And generally speaking, you're often retaining earnings to maintain those or upgrade those facilities. And oftentimes the upgrading those facilities does not generate profits. You simply are doing that to tread water. That's why I like to see retained earnings for these kinds of companies generally being low. And when I see there being a spike, I want to understand what that spike is. And in this case, again, the spike we've talked about. So this slide is not a problem for me. Generally speaking, I like to see companies over that red line. And I think if you look at 90% of the companies we own, you'll see that. But again, because I understand what's going on with this company, I'm willing to overlook that with what's going on in this business. So as they say, cash is king. One of the 5 things that we like, or that we know that companies can do with profits, is to retain cash. Up to a point, I'm happy when a company does that. Cash is a weapon which we can use to buy other companies, buy subsidiaries, or we can use to invest in opportunities, buy real estate, buy facilities, something we can do to survive the bad times when they occur. So I don't have a problem when the company retains cash. However, there does reach a point when the company has cash that they can't justify and that they should be giving me back to me as the owner. And they should be doing that either in the form of dividends, or preferably if the stock is priced low enough, they should be buying back stock. Again, one of the things that you benefit from by reading the annual report is that this company has just approved a $500 million stock buyback plan. I think the company stock is very cheap. I think that they should buy back stock. I would like them to use some of this $800 million in cash to buy back stock and increase my share and ownership of the company. I also think some of that is likely to happen because the company has just made a deal with the founders' family, and the founders' family used to have super voting stock, and they have agreed to go to regular stock, which means they go from 50% control of the business to 12% control of the business. I think the company's family may be looking to divest. Their holdings are about $400 million, and the board has just approved a $500 million stock repurchase plan. And I would not be surprised if over time, and maybe even a very short period of time, you see that this company has bought back the founders' family shares and therefore will own 10 or 12% more of the business than we do today without spending any more money. Another thing that I look at with the company is what they're doing with those sort of 5 proceeds of profits, right? So what are they doing to buy back stock? What are they doing to save money, to pay down debt, to retain earnings? And the net value of those things over time is what I'm looking at, is the quality and performance of the management. So the red line shows the sum total of those 5 categories for a 5-year period in the past. And you can see that this company has always generated a profit in any 5-year period of time frame. And right now they're really generating an awful lot of profits, and that profit is being used in a way which is creating value for the shareholders. Again, paying down debt is good for the shareholders. Hoarding cash is good for the shareholders. Buying back stock is good for the shareholders, and paying dividends is good for the shareholders, as well as intelligently retaining earnings. And they're doing those things. And so I'm very, very happy with the long-term performance of this company's management. So that does it for the stock Cal-Maine Foods. I think it's an excellent company and a very, very safe business. They won't be affected by tariffs. Tariffs are not an issue for this company because they import virtually nothing, and they only export 3% of their eggs. So therefore, there's not a big problem with somebody tariffing them out of existence. So this is a great company. I think you should own it. Pays a nice dividend. I believe they're going to be buying back stock, and I believe that their earnings are going to be very stable with very few, bad times going forward. I also